the New World Order, and look what it's done to the way the market caps have come crashing down in the US equity markets. And I just want to give a brief picture on how the US equity market handover has been, and we'll come to Asia as well in just a bit. But look at that, the biggest losses since COVID time 2020. It's a 4% cut that you've seen overnight on Dow. S&P 500 index knocked off nearly about 5%, and the Nasdaq lost more than 1,000 points, and that equates to about a 6% cut. Not just that, look at Asia. It's all a sea of red, much unlike yesterday, wherein you did see some resilience, at least from markets like China. Of course, China is shut on account of a trading holiday today, but even Hong Kong knocking down about 350 points. Japan is down nearly 850 points, and the periphery markets like Korea and Australia are no different at all. So adjusting to the new world order, I guess.
Yeah, it's a major risk-off moment in the world, and markets are not differentiating between what will gain, what will lose. Wherever there is liquidity, wherever there is a margin pressure, and wherever there are gains, I guess the system is simply trying to set. There is a mass panic, so to speak, because logically and mathematically, when there's uncertainty in the world, gold should have gone higher. When there is fear of inflation in US, then bond yields should have gone higher. And when there is fear of recession, then equities and commodities, they should have gone lower. What do we have on our hand? We have a synchronized sell-off in all asset classes where markets are not differentiating between right or wrong. The collateral damage what US equities have seen in terms of market cap erosion, it is the second highest in the history of US markets, and it goes back to the dark days of COVID, March 2020, when the US market on a single day had actually lost $3 trillion. So what we are staring at is the tariff trauma. It is the aftershock of something which will change the global landscape, and that adjustment, I think, is coming at a price. And the real casualty in this case has been US investors, US equity markets, and US bond markets. So what we're staring at, I think we're staring at a very, I won't use the word scary, but a clear risk-off moment in the world where right now everyone is running for cover. Nobody is differentiating between what will gain and what will lose. And the selling, I think, is very sharp, brutal, excruciating, and synchronized. You're not differentiating, you're simply selling. Jo bhi hai bech do. Kal dekhenge. And that is when you come into a panic zone. Technicals, compulsions, stop losses, leverage, all these factors are at play. These are, if we are sharing the data that this is as high as what we saw in the dark days of COVID, just imagine the kind of collateral damage what has happened.
Yeah. And especially, those overheated names. Look at how the tech mega caps actually fell. Apple fell about 9%, so did Meta. Amazon was down 9%, Nvidia was down 8%, and Tesla, which has already fallen considerably from its 52-week peaks, that also fell another 6%. So it really, smacks of capitulation. And clearly, the chosen lot is the overheated, those tech mega caps.
See, Aisha, the cracks have come where gains have been highest. Tech, US equities, and then gold. These are three asset classes which, in a sense, one is US equities, then within that US tech, and then you got a big crack which is happening in gold right now. Now, the point you could ask yourself is that, will it continue? Can this really have a cascading impact, and could it get as ugly as what happened in 2008? Now, technically, Aisha, there are two factors here. 2008 happened because of leverage. 2008 happened because of problems which happened in the US financial system. I don't think the news is that bad. However, technicals can really make the picture look much worse before it gets better, because this kind of selling which is across the board, it's not going to die down in a hurry, because there is not going to be a very sharp reversal in terms of what Donald Trump is trying to do in terms of imposition of the tariff. So you may actually see the market, in a sense, get into what could be called as a technical stroke momentum sell-off, which will be led by US equities. There would be US tech stocks in it. You will see volatility in the US treasury paper. And having said that, I think the outperformance what Asian markets are reporting this morning and what we've reported yesterday, I think that is how the channel or the chain of sequence would move. US will continue to remain under pressure. Money will move out of US. Dollar will continue to remain under pressure. At some point in time, someone would wake up and say, okay, the problem is in America. Why are we ignoring rest of the world? I don't think it's there yet, because today it's all red and everybody is selling because of compulsions. But I think somewhere logic will prevail. But for logic to prevail, it could take few days. It may take few months. I don't think it'll be few months, but it'll be few days for sure.
Yeah, definitely. For this new reality to set in, it's going to take some time. It's a big one. You haven't really seen such kind of tariffs all across the world. And of course, people are anticipating trade wars now. That's never really a good outcome. But yeah, Donald Trump, he's continuing to be as bullish as he ever is. He's saying it's going very well. The markets are going to boom. The stock is going to boom. Stocks, rather. The country is also going to boom. So he's pretty confident that nothing will change in terms of the prospects of America even after these tariffs. But it's peculiar, like you said, the way the currency market is moving, the way you're actually seeing a crack in gold. One would have thought that it would be a rush to gold. Yes, it is an all-time peak, but who says it can't go higher?
Aisha, there's no differentiation right now, like I said. When such a news hits you and when markets are at elevated level, technical compulsions, they take over, that's the time you don't differentiate. In an ideal scenario, you should have been waking up to a morning where US stocks were down, US yield should have not cracked, gold should have gone higher, and crude should have not fallen the way it is falling. Let's understand that it is not like the world's going to shut down because of tariff. It is not COVID, it is not financial crisis, it is something which will have impact, and the impact is going to be more long term, and the impact is something which, trade is something which if one loses, the other gains, right? And it is not that this is end of America and end of the world. And markets are behaving, it is end of America and it is end of the world. This kind of a reaction you've seen, let's say when 2008 happened or when you've seen the COVID, those were very different circumstances. This is not a black swan or a white swan or, whichever color you want to call it. This is a fear which has happened because of trade slowdown, reset of the world, new realignment. Ramesh Damani yesterday put it beautifully that this is peak America, but that does not mean rest of the world. There was a time when Gilder was peak of the world, and then it moved to franc, and then it moved to Great Britain pound, and moved to dollar. So the migration will happen, and the migration, I think, is the real deal. So it's not that SGX is down and out completely. It is not that you're seeing that kind of a panic. But let's understand what it means for us. And the phrase which comes to my mind is "Kal to bach gaya, aaj kya hoga?" Really, literally, right? Yesterday, if you really looked at Indian market, okay, it was just like a normal day, 0.5% here or there. You will mean for a gap down start. And after a gap down start, what may happen is that more of the same, which is that domestic driven sectors will move higher, global driven sectors will continue to remain under pressure. Pharma got lucky yesterday, but I think pharma stocks are expensive. I don't see something happening there. So now banks become the first port of call. Anything which has got to do with global undercurrent, whether it is steel, whether it is metal, whether it is auto, you have to avoid them. Domestically, I think cement becomes a port of call, consumption stocks, they become a port of call. And you must also recognize the fact that India was falling because dollar was high, crude was high, and flows were moving back into US market. So now flows will not go back to US market when things settle down. See, today everything will look universally red. But logically think about it. Think like 10 days. What were the pain points for India? FI selling, that should reduce. Second, dollar strength, that has reduced. Spike in crude, that already has gone down. And the readjustment in terms of IT versus pharma versus large sectors, I think that readjustment is work in progress. And I also sincerely feel, Aisha, that this is not the final tariff, no? Renegotiation, bilateral deals. Yeah. So by the time the actual
There'll
rollout...
There'll be a lot of rollbacks,
exactly,
which we will see in the days to come.
So that automatically starts becoming triggers. So you know the ceiling, you know the worst case scenario. Now you'll have to start assuming that, somewhere the administration will wake up and smell the coffee. And they will say, okay guys, markets are not happening.
And they're savvy businessmen.
And Aisha, one more thing, I was just thinking through it that, while in India, the total equity exposure is less than 10%, in America it's about 40%. Any public leader will not want to see a wealth erosion effect
for such a mature
market. 3 trillion is almost like India's GDP, which has gone wiped out in a day. Yeah. Little less than India's GDP, but just see the collateral damage.
If you like this video, then like, share and subscribe to ET Now.